Today, and I'm aware of time, so I'm going to try to convey, just 2 or 3 key ideas in the next, I guess, 18 or 19 minutes. I'm speaking here under the authority of Monica, but so let's go. So the title of my presentation today is really the pension and sovereign fund perspective. So I'd like to convey to you the worldview, so to speak, of long-term asset owners, and I'm using basically pension funds and sovereign funds as the epitome or the quintessential long-term asset owners. And I'm calling them smart creative capital, so that's an expression used in the late 1940s by General Georges Doriot, who's the inventor of venture capitalism. He was a French-American military planner and economist, and he's one of the founding fathers of the Silicon Valley back in the late 40s, early 50s, when it was a tiny little microscopic business. And many of the articles which he wrote in the early 50s are actually great, written in French and English, so I really recommend that you guys check them out. They're free on Google. And so he called what he was inventing, which didn't really exist back then, he called it creative capital. And I love that adjective. So ideally, a smart long-term investor attracted to venture capital, you can call him creative capitalist. And in this new era, these people, the pension funds, sovereign funds, endowments, they're of course looking, to superior risk-adjusted returns. I think that's, for them, for many LPs, cynically or realistically, this is the main draw, this is the main attraction of venture capital. The multiples of winning investments are amazing. So clearly, when they come to that asset class, they're attracted by what they perceive as superior risk-adjusted returns. And now, more and more, they also need meaning. So what do I mean by meaning? It's ESG. It's the E, the S, and the G. And now they want to make sure that their venture capital investments tick the E, S, and G boxes, so to speak. And we mentioned earlier today the World Bank, UN, SDGs, the Sustainable Development Goals, which are also very important, of course, for the European Commission. And by nature, because the EIB spends a lot of money in VC ventures in Central and Eastern Europe, the EIB itself and the EIF are also more and more incorporating these 17 SDGs in the way they go. So without further ado, the symbol here you have in the middle is the Warsaw Siren, and you don't really see it in that picture, but she's holding both a shield and a sword. And so basically the shield, you could say, is the risk management and ESG compliance, and the sword is the return, right? To make a long story short, the figures I'm going to give you today are just rough metrics, approximations, and they are a reflection only of my own personal, biased views. So the world in which we lived, we investors, VCs, GPs, LPs, the world we lived in the past 50, 60 years is now dying for many reasons. So it's not only, Brexit or Vladimir Putin or inflation. It's dying for many other reasons. But the way we went about investing in companies for the past 60, 70 years is changing. We're entering a new era. And that era, you could say it combines smart idealism. So that would be ESG, impact, green finance, humane finance, with something more cynical or darker, which I called here ultra-realism. And ultra-realism, you can use it as a synonym for geoeconomics. We're entering a new era called the age of geoeconomics. We'll see what it means for the venture capital industry. So what died is that era which started, in 1980 with Margaret Thatcher, Ronald Reagan, and it died, in the past, few quarters. So it lasted like 40 years, right? The magic era of neoliberalism, open borders, open market, blah, blah, blah. Even the left, even Tony Blair and Gordon Brown, they became neoliberals, right? So basically, even the socialist parties of Britain and Romania, they converted to the gospel of neoliberalism, but that lasted 40 years or 42 years, and it absorbed many shocks. And one of the shocks it absorbed was the great financial crisis of Lehman Brothers and Royal Bank of Scotland. But it wasn't that great. You know, it was a small financial crisis, but it was easily absorbed by the system. And the two founding fathers of that, I don't know if I have a pointer here, not sure, but the two founding fathers of that era are people who were ministers in the Reagan cabinet. One of them was Don Reagan, not Ron Reagan, but Don Reagan, and he came from Merrill Lynch. And the other one, I don't know if you have his name here, but so these guys, you know, these guys, yeah, Nick Brady. So Nick Brady and Don Reagan were the main drivers within the Reagan White House for that neoliberal revolution. And for them, it was important that when the Berlin Wall collapses, Eastern Europe would become neoliberal. It was very important for them. They came from Merrill Lynch and Morgan Stanley. They were traders. They were equity traders. So they really wanted, you know, they wanted the world to become like a big, giant financial market, the world including Central and Eastern Europe, and in many ways they succeeded. But that world is collapsing now. It is disappearing. And another world is emerging now. It is the age of geoeconomics. So what defines that new era were two things. You know, you have the eagle and the dragon. So really America and China are accelerating their rivalry. And it's becoming very bloody, as you can see from that painting. What does the word geoeconomics means? It means that in the old days, until last year or until 2 months ago, we had a pretty neat separation from, on the one hand, the world of finance, economics, investment, and on the other hand, the world of military strategy and diplomacy and national security. And these two words were pretty separated. And there was a big wall separating them. And now that wall is collapsing. So for big governments, for big investors, there's no longer a separation between the two, and it is having a huge impact on the way financial markets operate, and also on venture capital, because in the world of venture capital, you have a lot of what the Americans call dual tech. Technology, which can be used for civilian and military purpose. And because there are sanctions building in, because after Russia, NATO, Britain, America, they want to enter in a very aggressive race with China and vice versa, venture capital funds may be caught in a crossfire, right? So that's tricky. And my point is, you know, venture capital investors, both GPs and LPs, will need to take that into account. Very much so. You know, is my portfolio geoeconomics proof? That's very important. On the left, it's a picture of General Georges Doriot, that great French-American genius who invented venture capitalism. And he went on to be a professor of management at Harvard. And at the end of his life, he founded INSEAD in Fontainebleau. It's no coincidence. A big chunk of the VC and PE fund CEOs in Europe are alumni of INSEAD. It's in a way by design. So that's the new world, you know, a world very cynical, aggressive, ultra-realism, right? You know, governments are cynically using sanctions, not only slapping sanctions on that imbecile Vladimir Putin, but they're also slapping sanctions more and more on big Chinese companies across all sectors. And the US now, in the name of combating inflation, the US is reverting to protectionism and economic nationalism in a very indirect way, in the name of, you know, climate change and inflation. And so now America is subsidizing massively all sectors in the tech industry, even more than before. And in the coming quarters, many tech companies, large and small, in Europe, including Eastern Europe, they will suffer from that. Because culturally, the European Union is not mentally and culturally prepared to fight with these new rules. You know, the Chinese, the Saudis, the Israelis, the Americans, they already apply the rules of the geoeconomic game. In London, you know, Paris and Brussels, we still go by the old software. In the coming quarters, it's going to be more and more difficult for European, you know, policymakers not to adjust to that new reality. So who controls the world economy? It's the big asset owners. Because when you give money to a GP or to an asset management company, in most instances, the money that that asset management company or GP invests is not their own money. It's money that was given to them through investment mandates by the end asset owners. Who are they? Well, they are very often pension funds, and more often than not, public sector pension funds. So the biggest, actually, it's really difficult to understand. It's counterintuitive. The biggest capitalists, the biggest investors across all financial markets, including, VC and PE, are actually municipal workers and government employees and provincial government and state and local government employees from Toronto, Montreal, Sacramento, Chicago, Manchester. They are the heroes of capitalism. And so they are public sector employees, and they are employees. So they have what you could call a center-left ethos, because many of the board members of the biggest pension funds in the world are actually nominated or elected by civil servants. So they have that sort of long-term, center-left, civil service ethos, but they want returns. So they really want to earn money on their VC, PE, equity, etc. fund investments. And so they can either buy directly shares into companies listed or non-listed. That's the direct arrow. In which case, they don't need you guys. They don't need a private equity or VC firm. But in most instances, they invest indirectly, so they give investment mandates to private equity firms, VC firms, and you guys call them LPs. So that's the indirect upper arrow, and you guys are the guys with the big brain in the middle, because you're supposed to be smart capitalists and make the most of the money they give you. So this is a very rough approximation. So here you have annualized economic growth in the past 9-10 years. Once again, it's in the past 9-10 years. So countries like Chile or Britain look well, because I'm taking annual growth for 10 years. If you focus on just the past year or two, countries like Chile and England are not doing that well. Now the size, the combined size of all pension assets is that axis. So what you can see here, that there are only 6 or 7 pension superpowers. These would be the big flags. And actually, I've had to reduce the scale. The flag of the US and Australia should be even bigger, and the flags of Germany and France and Italy smaller. But what I'm coming at, there are only 6 or 7 pension superpowers in the world. So there are only 7 countries who control 90% of the world's wealth, including 90% of money invested by PE and VC funds, right? So it's a very important thing to bear in mind when you're selling stuff. Who should I call? Should I call a Czech or Portuguese pension fund? Or should I focus on Montreal, Toronto, Amsterdam, and Sacramento? So there's a high concentration of power, financial power. So there are only 6 or 7 pension superpowers in the world. Only 2 or 3 are in Europe. And after Brexit, there's only one left in the EU. It is Holland. Holland, and to a lesser extent, Denmark and Sweden. So in spite of all the gloom and doom that you hear every day in the Wall Street Journal and the Financial Times, Britain has something good going for her. It's the size of its pension and insurance industry, which compared to Britain's GDP is huge. It's all its faults, not here to promote the English government, but it's all their faults. English policymakers have something great. It is the domestic pension market is relatively big, and it's something to build upon. So if you are a venture capital fund, well, literally around that hotel, within a half-hour walking distance, you have tens of big pension funds, insurance companies, and endowments. So it's really something very useful if you're selling a VC or PE fund. Now let's look at the average asset allocation. So typically, let's take, for example, let's take this here, this or this. So this is here big Dutch pension funds. But let's say that the average large European pension fund looks like that brown-yellow sphere. So what does it mean looks like that? It means that on average, a big European or UK pension fund, they will invest roughly 18 or 19% to non-listed assets overall. And so what does it mean? They would invest 17, 18% to non-listed private markets. It means that on average, big pension funds invest 82% in plain vanilla bonds and blue chip stocks. So the portion which is invested in non-listed private assets is only 17, 18% at most in Europe and England. And out of that 18%, you have private equity, infrastructure, real estate, and hedge funds. So how much do they invest on average in private equity, including venture capital? 3% in Europe. It is much more in America, Canada, and Asia. So the figures you will see in the financial press are biased because they are average figures, including these huge Canadian, American, Australian pension funds. And because the data are biased, you would think that there's much more. But in reality, let's stay here in Europe, Britain, the EU, they invest on average 2.53% to PE, and a fifth of that, at most, is venture capital. So that's really 0.7% of their portfolio. However, the good news is they have a lot of money. A lot of money. So even 0.6 or 1% is actually not bad for you guys looking to bring in tickets of 5 million, 10 million. It's fairly easy for them to give you 15, 20, 30 million because they have a lot of money, right? And I think I just have 3 or 4 minutes left, so I'm going to finish with, after all that depressing news, with some positive news. I think that really the prospects for Central and Eastern Europe are quite good. You know, and of course, right now, you know, you look at Hungary right now, or Moldova right now, or Ukraine right now. Of course, even Britain. You know, if you look at the GDP growth prospects for Britain and Hungary for the next, you know, two years, they're bad. But remember, pension investors, sovereign wealth funds are long-term investors. So they when they put money into a VC fund, it's for 6, 7, 9 years, right? And so for the next, I'll do it slideless. So for the next, for the next 5, 6, 7 years, the growth prospects of Central and Eastern Europe are higher than EU average. That is great. That is great because when you're putting money in VC, you want growth. Secondly, there's one thing which Central and Eastern Europe has going for her. It is that Chinese-American rivalry. That is good news for you guys. Because in the age of geoeconomics, well, you know what? Look at geography, geoeconomics. Romania, Bulgaria, Greece, Hungary, Israel, Cyprus will be courted by both. So they'll be courted by both China and America and the EU Commission. And so when it comes to, supranational money, government subsidies, public investment in high-tech, tech, VC, you guys in the future will have many, Americans, Chinese, EU guys knocking at your door because of the geographic position that Eastern Europe has in the heart of the New Silk Road. So that New Silk Road is the battlefield where America and China will fight for the next 30 years. But that fight won't be a fight with Scud missiles or, Sukhoi bombers like the Russians do. It will be a fight focusing on tech, high-tech, fintech, venture capital, and trillions every quarter of public money from America and China and the EU will go into that region. So being courted by both sides of the new Cold War is actually quite good. So I think that's good news. And that's why maybe you see that, to give you an example, that the Israeli government is being pressured to take sides in the war in Ukraine, or the Saudi, let's take the Saudi or Israeli government. They make extremely pressured to take sides in the war in Ukraine. And you may think they're cynical, but they're refusing to take sides because in the new Cold War, they want to remain neutral. And they think that Russia is irrelevant. So, of course, if you live in Lithuania or Finland or Romania, Russia is not irrelevant. But for many other emerging markets, Russia is a declining power, and they don't care about it. And so what they look at is China and America, and they say, look, it's a new Cold War. We want to remain neutral. Being neutral will be good for the VC industry in Tel Aviv or Riyadh, blah, blah, blah. So this is really the world in which we live in today, ultra-realist. But I think, for your part of the world, it's also on the flip side of the coin, it's also positive news. Thank you very much. Thank you.